Welcome to Multifamily Mondays. We go live every single Monday at 12 p.m. Eastern Standard Time. Thanks so much for joining me. Really excited today. We are talking about some big changes that have happened and will be happening with CMHC. So if you are a Canadian real estate investor, especially in multifamily, you definitely want to stick around for this episode. My good friend Pierre-Paul Turgeon, past speaker at MFC 22 this year, and he's also a speaker at the boot camp we're running for the multifamily conference coming up May 26th to 28th, 2023. He's going to be walking you through all the foundational stuff when it comes to multifamily underwriting. And he was actually a multifamily underwriter with CMHC. So he is the guy to talk to for that sort of stuff. So Pierre-Paul will be joining me after the break to really break down all these important changes coming and that have recently happened with CMHC. So if you're into multifamily investing in Canada, you definitely want to stick around. So speaking of underwriting, I think it was last week or the week before, I sent out a message to everybody, the whole community, asking if you would be interested in a free underwriting workshop. There was a whole lot of interest in it. I got a bunch of emails back saying, yeah, absolutely. So it looks like we'll be running something in January. So you'll just want to watch out for an announcement. We don't have a date yet, but we will be hosting a free underwriting workshop. It's probably going to be like 2-3 hours kind of thing, and we'll just walk you through step by step. But to get things started today, I wanted to walk you through the 3 T's of underwriting. This is a really important framework that I kind of discovered by accident. So basically what happened was, when I was starting into multifamily real estate, I was experienced in single family home investing, and I decided for a number of reasons to get into multifamily. So I started looking at some deals online. I started talking with brokers, and then they would send me these deals and say, hey, what do you think? And I was literally like a deer in the headlights. You know, I'd be looking at this, they were even small ones. So like a 15, 20 unit building. And I was like, what? I had no idea what to do. All the numbers, I'm not naturally a math person, so I got really overwhelmed and I had no idea where to start. So basically the broker was like, oh yeah, what's your feedback? What do you think? And I had no idea what I was doing. I knew how to look at smaller single family stuff, but when it came to the scale of multifamily, no idea where to start. And I really struggled with it because I didn't have a system. I didn't know what I was doing. I didn't have a tool, all that sort of stuff. So we're going to be covering that in the free workshop. But today I wanted to cover the 3 T's of multifamily underwriting with you. And quick reminder before I head over to the whiteboard, we are a couple days away from announcing our November winner for the free elite ticket to the multifamily conference. All you have to do is like the video and comment on this video, and you're automatically entered into a free ticket draw. Loaded elite ticket that gets you into the Friday workshop as well as the after party at Rebel Nightclub. We're working on getting a really good band. We're working on it. I don't have a big announcement yet, but we're working on it. So make sure you like and comment, and I'll be giving away a free t-shirt today too to somebody who likes and comments. Katie will wrap that up. Okay, so let's head over to the whiteboard today. Oh, we had last week's stuff on here. Okay, let's get rid of that. Now let's talk about the 3 T's of underwriting. Now, this wasn't always the 3 T's of underwriting. It was actually 2 T's and an E, but then I figured, you know what, we'll change it to the 3 T's. So the first T of underwriting, because like when we're underwriting properties, we're really making educated assumptions about future performance, right? We're giving our best guesstimate as to what will happen with the property at some uncertain time in the future, right? We may have a horizon we're looking at. Maybe it's 5 years down the road, 7 years down the road, 3 years down the road, but we're really making educated guesses. So what we have to do is we have to make the best educated guess, the guesstimate possible with the best data we have. It's like anything, right? You put garbage in, garbage comes out. But if we put really good stuff in, even though nobody has a crystal ball, like mine's out of batteries right now. If you've got a working crystal ball, let me know. But besides the crystal ball that's in the workshop right now, we don't really have anything that's 100% certain. So what we have to do is we have to come at the problem with, or the property with the best model possible that's going to leave less guessing, and put in the best data we have. So the 3 T's of underwriting, this is really a 3-step process on how we tackle an apartment building. And I'm sure Pierre-Paul will touch on this as well. So the 3 T's. So the first T is today. We have to have a really good idea of what's happening with the property today, right? We have to take a look at the exact numbers, deal in reality. A lot of times, the broker will sell you or will send you a pro forma, and that will contain some very rosy future projections. You can't look at that. So I actually have a whole system that I walk through when we're underwriting a deal. But number one is you have to look at the property today. So first thing you do is you look at the T12, and the T12 is the trailing 12. So this is the financials of the property for the past 12 months. So what this does is it allows you to see trends. Is the rent trending up? Is it flat? Is the rent trending down? How many units were rented in the past couple months? Because a lot of times what a seller will do is they know they're going to sell the property. They'll just rent it with whoever in the months leading up to it so they can show a full rent roll. But you're not going to get maybe the best quality person in there if they're just trying to find any warm body to plug in there, right? So they can advertise, oh yeah, we're 98% full. So you want to look for trends, right? What was the vacancy of the property in the past 12 months? Did it really... Did occupancy really shoot up in the months leading up to the sale? Yes or no? You want to find all these different sneaky trends that people put in there. Expenses, right? Are expenses climbing up? Are there really big one-time expenses that are hidden in the T12, right? Maybe, or sometimes what people will do is you'll have an operational expense or a capital expenditure. I'll get into that totally on another day. But basically what some people will do is they will classify an expense as one versus the other one just to really boost up that NOI, because a capital expenditure, a one-time improvement, that doesn't get counted in the NOI. But an operational expense does. So you really have to watch out for that, because people try and hide expenses in that T12. So when you're looking at today, you want to form the best possible picture you can of the property right now. And the best way you do that is through real numbers. So you're not working on projections, you're just working on fact. And fact is hard numbers. So you look at the T12. Then you look at tomorrow. And this is where the guesstimate comes in, right? So with tomorrow, you are starting to project out future growth. And you really have to have a handle on your business plan, right? So it all comes down to your business plan. So today, you're looking at what's actually going on at the property. Now you're starting to say, okay, well, the property's operating here today. How can I actually take it up here? So maybe you have under market rents. Maybe you have renovations that you can do. Maybe you can add in amenities. Maybe there's a hole in the market that isn't being exploited. Maybe the property's operating, it has really bad management, and the closing ratio of the leasing agent is really low. Maybe it has really bad marketing. Maybe there's a stigma associated with the current owner. All of these problems you can fix, and this is how you make your money. This is why we want to control as much as possible in the deal. So you know where the property's at today. Now you have to figure out how you're actually going to make money in the deal. So you come up with your business plan. Now, if you've tuned in before, I talk a whole lot about the value add strategy. So this is acquiring a property where it needs improvement, whether it's physical or operational. Those are the two columns we work in value add. So for instance, some examples of physical, and we'll just do this right here. So we'll do physical and we'll do operational. So physical improvements would be renos. So you could do kitchens, bathrooms, flooring, paint, interior renovations. You can do exterior renovations, change the roof line, paint the outside, change the siding, take down trees, add trees, redo the pool deck wherever you're at. These are all examples of exterior renos. Then you can add amenities. So maybe you can add a pool, add a gym, add a business center, remove the tennis court, and add in a playground or a barbecue pit, depending on your residence. All of these things fall under physical improvement. Now, when we, and there's a whole list that we can do. And on the operational side, just to give you guys a couple examples. So number one is you raise the rent, right? That's the easiest one you can do. You acquire an underperforming property, you have $150 rent, deficit, and then you can raise the rents. There you go. That's your easiest one. And then you can work on other things, like you can actually tweak your expenses. Maybe the insurance policy on the property The current owners just had the same insurance policy for 3 decades. They've never really shopped the market, and they're paying 3 times the market rate for insurance there. Tax assessments. Maybe you can fight a tax assessment and decrease your tax expenses. Also with utilities, you can bill back to the tenants. All of these sorts of things fall under the operational improvement side. So this is really your business plan. And what you're doing in the tomorrow phase is really figuring out, okay, this is exactly what I have to do to get the property from down here all the way up here. What's that going to cost, right? You have to figure out how much CapEx, so capital expenditure, you're putting in to improve the property. You have to figure out, all the debt. So what's your capital stack like? What's your equity position there? What kind of debt? Are you going to bridge debt? Are you going to do conventional debt? If so, what are the rates? What's your strategy? If you are bridging, when are you going to refinance? Is that in year 2? All of these sorts of questions fall in under tomorrow. And what you're doing is you're taking the hard data that you have here, the real numbers, and now you're starting to apply some guesstimates to it, but in the best possible way, because you want to stay centered in reality. So you want to look at where the market's performing today. You want to use comparable examples that are an apples to apples comparison. So that way you're not just coming out of saying, coming up this process saying, oh yeah, I can achieve a $300 rent premium, when in reality, all your competitors are, just charging $200 more than the subject property, right? That's $100. That's fairy dust at that point. So that's tomorrow. And then this used to be called, the third step used to be called exit, but I changed it to get to the 3 keys. So now I call it terminus, which means the end. So this is when you exit the deal. And you're going to be making a whole bunch of assumptions about the state of the market and the property when you exit. And this is why it's really important to be conservative and come up with a whole bunch of different exit plans or strategies depending on what's going on in the market. For instance, a good example would be if you acquired a deal 5 years ago and this year you were planning on exiting, the market has shifted. So the market 5 years ago when you acquired is no longer in the market today. So what is your exit plan? Did you stress test accordingly in the deal to make sure you're safe in it? So what we're doing with the terminus is we're projecting into the future and saying, okay, when the deal is done, when the deal ends, when I want to sell and get my money out so I can reinvest it in another deal, what does the market look like? Right? If you're buying the property today at a 4.5 cap, you will not assume that you are going to sell at a 4.5 cap. Now, everybody has their different strategies. You may test at a 5 cap. You may test at a 5.25 cap just to see how that impacts your deal and if it still works, right? Because the main thing to remember with underwriting is it's so easy to put numbers into a spreadsheet. It's another thing to take those numbers and make it happen in real life. So it's we've seen a whole lot of people, especially when you first get started out. Oh, you're in a multiple offer situation. Oh yeah, well, I'll just tweak these numbers here and then the deal still spits out the return I'm looking for. It works. Well, it's one thing to change the spreadsheet. It's a totally different thing to actually make it happen. So you want to keep that in the back of your head as you're going through the 3 T's of underwriting. Today, what the property is doing today. Tomorrow, what's your business plan? How are you going to get there? And then terminus, what's the market going to be like when I sell? And also when we're talking about the terminus, is this fits in to your business plan up here. Because you have to think about, well, who is your end buyer? Who's actually going to buy this property from you when you decide to exit, right? Because what will happen is if you, in your business plan, if you have, let's say 50 units, 100 units, and you improve all 50 or all 100 units, you're not leaving meat on the bone for the next buyer. So how's the next buyer going to make money in the deal unless they're just parking cash? So you want to keep that in the back of your head and really think about, okay, well, how can I set up my property when I exit to have the best product for a potential buyer, right? Because you bought the property because it had meat on the bone, you can make money on it, and the next buyer will want to do the same thing. So this has to really wrap into your business plan, and this helps out your selling strategy so you can get the maximum value for the property. So today, tomorrow, and terminus, always want to be conservative because you never know what's going to happen in the market. 2 years ago, we had really cheap money floating around everywhere. Governments were printing it. Today, money is a lot more expensive. 2 years ago, you probably didn't think this would happen. So you will always want to be conservative in your underwriting and plan for eventualities like this. So these are the 3 T's of underwriting. I really hope this helps you out as you approach a new deal, as you're analyzing the deal. And I'm going to have something really special for you in a couple weeks when we announce that underwriting workshop that we'll be running. So today, tomorrow, and Terminus, that used to be called Exit, but I like 3 T's better. So before we get to the break, let's just do one quick reminder. Make sure you like and comment for the video, not only for the monthly draw for the free multifamily conference ticket, Loaded Elite, but also I want to give away a t-shirt. I'm wearing the Mogul in the Making shirt today. Then we also have the Unit Size Matters t-shirt as well. So this is my favorite one. And we've got a whole bunch of comments on that. Everybody loves it. So let's go to the break. Stay tuned for Pierre-Paul Turgeon. We'll be back in 1 minute. All right, welcome back. Really excited to have my friend Pierre-Paul Turgeon here to talk about some changes happening at CMHC. So this is a really important subject, and I'm really happy you're on here because we want to always stay abreast on what's going on in the financing world. So Pierre-Paul, welcome.
Hi, Seth. How are you?
I'm good. You are looking very good right now. So that's nice. We need to go on a vacation with some sun. You know?
Of course, beautiful Italy. Io parlo l'italiano, mi piace la dolce vita. So I went to Italy for my 25th anniversary with my wife just a month ago. So a lot of fun.
Very nice. You know what? Darcy and I are planning on going to Italy for our honeymoon next year. So you'll have to give us all sorts of tips.
Yeah, and it was great. It's a country that I absolutely love, Seth. I've lived there, and I went back to the town where I learned Italian some 40 years ago. So it was quite emotional. I was 20 years old back then. Can you believe I turned 60?
No.
Yeah.
Absolutely. No, you're doing something right.
I think so. Staying in shape, and all that stuff like you do as well, Seth. But I'm super stoked to be here with you, Seth. And I don't know. I know you're the host, but I got to say, I love a few things that you're saying about deals, leaving some meat on the bones. That's so important, right? That's how we all make money. And I really appreciate this kind of value that you're proposing. I think it's great because a lot of investors don't necessarily do that. They're very greedy. Anyway, I just thought I'd mention that to you.
Yeah, no, thanks. Like basically what I do is I think about like all the things I messed up when I first started. And then I basically want to share what I've learned with everybody so people can avoid the same mistakes I made. And you do the same thing, right? Like
absolutely.
you give so much
about my mistakes when I teach, as you know, it's important. Yeah. Absolutely.
Yeah, for sure. So let's get onto the subject at hand, which is changes with CMHC. And we've got a bunch of people putting questions in. So maybe what we'll do is we'll open this up to some Q&A at the end. And that way we can run through all the questions. So I guess, first of all, can you walk us through some of the product changes that have happened at CMHC, just in case people aren't aware?
All right, and Seth, I didn't get a chance to do a tech check with Katie, but I do have a bit of a PowerPoint which I lost before we got on, which is why I did the tech check. But now it's there. Is there a way I can share that with you or not?
You should be able to. There should be a share button at the bottom.
Present stop cam. If it's not a big deal. But I'm looking.
Yeah, if you hit present. you should be able to share your screen.
Aha. Here we go. And I see slides. There we go. Look at that.
Beautiful.
I have to slide them in there on my computer, maybe.
Yeah.
Let's
So
see.
as you figure that out, Pierre-Paul, what I'll do is I will just say we've sent out, I think, 5 free t-shirts so far, and everybody's loved them. So I want to send out a free t-shirt to you right now. Watching, as long as you like and comment. Katie will be picking the winner today for the free t-shirt. So make sure you like and comment. Not only will you get the free t-shirt, but you'll be entered into the free ticket to the multifamily conference. Are we all set, Pierre-Paul?
Well, I'm going to start, first of all, while I do this, because I think I can do 2 things at once. So we'll just check this theory. But first thing that came out, so when COVID hit, Seth, CMHC, and again, you said that it's important to keep up with the current changes in the rules, right, of the game. So the first thing that CMHC did early July 2020 was to limit the use of equity takeout funds. All right. So what they said is that equity takeout funds use is limited to basically building another apartment building, another multifamily property, basically to pay out a construction loan. I'm just trying to pull my slide here. Here, one quick second here, as well as completing improvements to your apartment building, and doing capital repairs. And yeah, so I've got them all. So let me recap. So in 2020, and this was earth shattering, by the way, I want to tell you this, Seth. So you can use equity takeouts. When you refinance, you take a portion of the equity out of the asset. You can use those funds now specifically for these purposes. Buy another one, build another multifamily property, complete CapEx, capital repairs, and securing permanent financing on a construction loan. Okay. The reason it was earth-shattering when this new rule came out in the beginning of COVID in 2020 was because a lot of us, including myself, as a business model, and I believe, Seth, you probably use it the same way as well, as a business model, we would take a portion of that equity and pay back, shareholders, their initial capital contributions, or if those had been repaid, dividends, right? So that was pretty earth-shattering. The only way you can get around that, you cannot with CMHC, but if you want to use equity takeout funds to pay back investors, you have to go with a conventional financing, which is non-CMHC insured financing, Seth. So that's one of those things here that happened. First big change in rules, if you will, for CMHC. The next one actually was implemented last year. CMHC in the past never required you to get an appraisal for your deals, okay? And that was on purpose. The guidelines were, do I have the guidelines anywhere? I don't have them handy, but CMHC guidelines, it says that CMHC reserves the right to determine the lending value. For the listeners watching, the lending value is the value that the lender will use, whether it's CMHC or a conventional lender, to determine what percentage of that lending value they'll finance. All right. And on purpose, CMHC did not require an appraisal because they did not want to be bound by that appraised value. So I can tell you my days when my butt was still sitting in the cubicle at CMHC, how many investors were frustrated by the fact that CMHC always used to have a lower lending value than market value. Well, since January of last year, so 2021, anything between 5 and 24 units, when you go in the CMHC financing or insured financing route, you need to provide an appraisal. And in talking to lenders like you, I'm in the business, so I talk to lenders, mortgage brokers. CMHC is truly making an effort to use market value as provided in an appraisal now. So I think it works in everybody's favor. So those were some of the big changes as well that occurred since COVID, and it's a good thing. Back in 2017, the federal government, this is the Trudeau government, launched a national housing strategy, right? At $72 billion to create more affordable housing and, of course, thousands of well-paying jobs. This is the lingo that they're using. So basically what that entails is it's a one top-up, one-time top-up to the Canadian housing benefit, a tax-free payment of $500 to an estimated 1.8 million low-income renters struggling with the cost of housing. Okay, and those who are eligible actually are going to be getting their $500 sometime around December 12th, December 12th, 2022. So that's one thing that CMHC has been doing. Another one is called the Housing Accelerator Fund and Rent-to-Own Program. Obviously, the rent-to-own program, you and I don't do rent-to-own stuff, but it's good for people to know this, okay? And the government has gone out to ask or put out a call for ideas out there to see how we can alleviate the housing crisis. And Seth, you know as much as I do, and you live in the GTA area, this housing crisis that we are experiencing, they're experiencing it in the States as well, but in Canada, I think it's even more dire, more serious. We're in the right business, you and I, providing rental accommodations, because it's going to take decades to solve this housing crisis. So in any case, they've got a call out. It's called a Housing Accelerator. Basically, the goal of this is to remove barriers and help municipalities build more housing more quickly in an ambitious and innovative manner, right? That's all the lingo. So that's basically what we're talking about. I think it's going to be very challenging, Seth, for a federal government to do that and dabble into, a jurisdictions that of the municipalities, right? That's not really the federal government's, jurisdiction. So I don't know how they're going to encourage cities to issue permits a lot faster, but that's what they're doing. Another one, are we able to take a break while I share my screen, Seth, or do you want to take a quick second? I was just about to download this presentation, Seth. Are you there still?
Sure. Yeah. So what we'll do is I'll do some Q&A right now. We'll take you from the stream, and then we'll bring you back in a couple minutes.
Fantastic. Because what I want to do, Seth, this is a big one. It's called MLI Select. It's a brand new product that came out in March from CMHC. I think this one has a lot of big promises. So why don't you take some questions, and I'll upload my presentation if you don't mind.
Beautiful. Okay, so what we'll do is we'll remove you here, and we'll bring Pierre-Paul back in just a little minute. All right, so Katie, do you want to go through? Okay, so David, we'll save that one for Pierre-Paul when we come back. Katie, did we have any questions about the 3 T's of underwriting? And then maybe I'll go through those. I want to save all the specific ones to CMHC for Pierre-Paul when we get back. I see Adele. Yeah, unit size does matter indeed. Great t-shirt idea. Honestly, you want to know the story behind these t-shirts, because these are great. So with the multifamily conference in 2022 earlier this year, this was an idea I had, and then I floated it by my fiance, Darcy, and she rolled her eyes so big it was shut down. But I got the team behind me this time, and we printed the shirt. So limited time run, and we are actually looking at doing some people for these moguls in the making. A number of people had requested like kid sizes and like onesies for babies for mogul in the making, and we're looking at doing those pretty soon in time for the holidays. So stay tuned. The merch department now is on the way. All right. All right, so let's see if Pierre-Paul is ready. Pierre-Paul, give us a thumbs up if you're ready. Oh, no, he's still working away. All right. So we've got a Facebook question too. We'll save that, Katie, for Pierre-Paul as well when we come back. You know what we'll do? Katie, let's take a 1-minute break. Let's go to a commercial, and then we'll come back in a minute 30 when Pierre-Paul has it all downloaded. All right, stay tuned 1 minute, then we'll come back. All right. So, yeah, I saw Mary just said you recognize some of the faces. What new challenges are coming up for raising capital in 2023? Great question, Jacob. And you know what? I'll run with that question as we wait for Pierre-Paul. So, Jacob, actually, I should mention, is another boot camp speaker. So, basically, what we're doing for 2023 at the Multifamily Conference is we've got the main conference on Saturday and Sunday, but we're running a really intensive boot camp on the Friday. So basically, this is geared towards beginners and intermediate investors, and we're working on foundations. So that way, when you're at the main conference on Saturday and Sunday, your brain is already revving, and you've got that momentum from the Friday because you've got all the foundation built already. So if you're a beginner multifamily investor or you're just getting started, you definitely want to come to the boot camp. Pierre-Paul Turgeon is a speaker. Jacob Perez is another speaker coming in, and we're going to be covering everything, like every single component of multifamily is covered on the boot camp. So strongly recommend that. But in terms of raising capital in 2023, I think right now, and especially for myself, right, because I've got an active deal that we're working on right now in Tucson, a lot of investors just will need some more reassurance, right? Like they want to understand that, yes, you've gone through the underwriting process on the deal. You've worked out possible eventualities. You know, a lot of people are worried about hyperinflation. What's the debt market? What's the impact going to be on your deal? As long as you have those answers and you can have that honest, genuine conversation with your investor and say, hey, listen, you know, these are the numbers. This is the underwriting on the deal. We've actually worked out these 5 possible scenarios for exit, which is the terminus I talked about. We've worked out these 5 different scenarios. We've accounted for rising rates if rates don't stop. We've accounted for a drop in the market. We've accounted for this and this and this. That's going to make your investor feel a lot more confident, because right now, in the media, on the newspaper, on the radio, online, it's all doom and gloom, which is very, very common. But there are still good deals out there. And right now, honestly, like you look at the stock market, you look at all the different investment products out there. I can't think of a better place to put my money than an apartment building, right? Because they're proven to be the most stable asset class during downturns. So where else would I want my money other than an apartment building during a recession, right? Also, the cash flows there. A lot of other investment opportunities, you look at the stock market, dividends aren't there, like they're taking a hit. You know, cash flow is strong with apartments, and you've got the stability too, and then you've got the forced value add. So you're not waiting for the market to appreciate. You're creating your own value in the deal, which is we were talking about the tomorrow aspect in the 3 T's. So I think, you know, it's just a matter of showing your work and helping the investor understand that, yeah, you've accounted for a whole range of eventualities in the deal, and that's going to make them feel a whole lot more confident. So, you know, you just need to hold investors' hands a little bit more, and just make them feel confident that you've assessed the deal. So, great question. And then how do you get the existing low rent tenants to leave in Ontario? That is very tricky. Well, welcome to rent control. And I'm sure Pierre-Paul and I can go on for a couple hours about rent control, which is why I personally focus in the US. All my single family stuff was in Ontario, but I would rather go to a place where I have a lot more control and the government's not sticking their fingers and telling me what I can and can't do. Pierre-Paul, do you want to give me a thumbs up if you're ready? Or are we still working?
To Katie, so if Katie can manage to share it for me, because I uploaded it, but it's not a big deal, Seth. I can go ahead.
Okay.
Absolutely can.
All right. Yeah, we'll talk about rent control in a little bit, Shelley. So let's get into the good stuff here, Pierre-Paul.
Yeah. So this new program, Seth, is called, and Katie, if you can upload it, and I can speak to it if I have control. But in any case, it's called CMHC's MLI Select, as part of this, Housing Accelerator Fund, and the federal government trying to create more affordable housing. CMHC came up with this program, CMHC's MLI Select. There's basically the guiding principles are the following. They want greater participation of new affordable units and preserve existing units at the required depth of affordability. All right, so that's one of the guiding principles. Then they want to make housing more compatible units with basically with what are we talking about climate changes, if you will, make the buildings more environmentally friendly. And the third priority is accessibility for handicapped people. So that's basically what it is. The kind of loans that can be that you can apply for. Now, obviously, we're talking about CMHC insured financing. MLI Select is eligible for construction loans, improvements on existing residential housing, purchasing residential housing as well, refinancing loans for residential housing, and the purchase and conversion of non-residential buildings to a residential use. So that's what they're trying to accomplish here. What kind of borrowers can apply for CMHC's MLI Select? Individuals, as always, trusts, limited partnerships, corporations, nonprofit and cooperative housing, foreign investors, which is kind of interesting. I want to know how these guarantees are going to work out. But anyway, you're used to that, Seth. You invest in the U.S., but they also province or provincial, territorial, municipality, and public agencies can be eligible borrowers, as well as pension funds. So basically, a whole gamut of potential borrowers can join in, because we need to address our dire housing crisis in Canada. All right. What else? So I've talked about that. Now, what's interesting, the goal here is to so in terms of the affordability, basically, and I'm going to have to say this because a picture is always worth 1,000 words, unless Katie was able to put my slide up. Maybe, Katie, are you able? It's a scoring system, what you need to understand, that CMHC has. And basically, let's take affordability bracket, one of the three goals, right? Remember, it was affordability, climate friendly, and accessibility. You need to keep a certain number of your units affordable. That's like at the maximum of 30% of the median renter income, okay, to be eligible for this kind of product. And I'll tell you, the advantages are really, really, really significant. But you gotta tread carefully and analyzing properly given your business model. But the more units are, let's say, if I pick the one outcome, which is affordability, if you keep your units, and I'm just going to brush up a general picture of it because I don't have the full slide in front of me, but if your units are affordable for, let's say, a period of 10 years, right, and they're up below the 30% median renter income, and CMHC provides you with, for different regions, with the stats, what are the various median income for renters in various parts of Canada. All right, so there's a spreadsheet that you can get for that. And like I said, Seth, I'll share the links with the audience for all of that stuff. Okay, but let's say I keep my units affordable, so below the certain threshold, the median income level for renters. If 40% of my units are at the 30% median renter income, then I get 50 points. If, however, it's 60% of my units that are at 30% of the median renter income, then I get 70 points. And you can see so on, up to 100 points if my units, 80% of my units in my multifamily property are at 30% of median renter income, I get 100 points. What do you do with those points is the next question you probably ask, right? If I get 50 points, right, so that's 40% of my units are at 30% median renter income, my premium is going to be significantly lower. It's going to be at 2.25%, okay? Premium what? This is a mortgage. CMHC is a mortgage default insurance company. So it's like any other insurance company. You pay a premium, but the premium is significantly lower if you get 50 points. Not only that, but you can go up to 85% financing, okay? That used to be the maximum for CMHC insured financing. It still is. Well, no, it's not actually, because if you get 100 points, you actually can go up to 95% financing. Okay, I want you to pay close attention. That means 5% down technically. Okay, you can buy a multifamily property, or you can build one and all this stuff, convert one, like for the types of loans that you can get that I was mentioning earlier. All right, listen to this. The minimum DCR now, and that's for all kind of points. If you get, whether you get 50 points, 70 points, or 100 points, the minimum debt coverage ratio is 1.1. Okay, that's very low. Normally for CMHC, for 5-year loan term, apartment buildings, 5 units or more, or sorry, 7 units or more, it's 1.3. All right. So the threshold, and just, I don't want to get too technical with people, but DCR is your NOI divided by your annual mortgage payment. It's a ratio, not a percentage. All right. That means your NOI covers your annual mortgage payment 110 times, if you will. So that's pretty close. So that's the kind of stuff. Now let's talk about amortization again.
Okay.
Let's
and Pierre-Paul, we do
Yeah.
have your slide up now. So just tell me which slide you want.
The last one, slide number. Yeah, there you go. That's the one.
You got
Seth.
it? Okay,
Right,
perfect.
a picture's worth 1,000 words. And like we said, I apologize. I had issues with my computer the last few weeks, couple of weeks. So there you go, Seth. So you can see now if you get 50 points, so people can follow the bottom of the screen, up to 40-year amortization. All right. Now let's be clear. If you go for a 40-year amortization, you need to have a building inspection report that indicates that the REL, the remaining economic life of the entire building, exceeds the chosen amortization period by 5 years. In other words, the remaining economic life of the entire building has to be 45 years if you go for a 40-year amortization, and so on. So there you go. It's quite. I think it's going to go a long way to alleviate the housing crisis, Seth. But there's some risks. For me, when I look at the DCR 1.1, it's very low, right? So if something should happen in the marketplace, the market crashes, you don't have a lot of buffer there. So I want to caution the audience, Seth, you got to be careful about that. You don't have a lot of buffer.
Yeah. Do you want to just go through
it improves your cash flow.
Yeah. Do you want to just go through debt service coverage ratio, just in case somebody doesn't know what that is?
Yeah. What the DCR, so I just gave the formula, Seth. It's NOI divided by your annual mortgage payment. So it's a ratio, not a percentage. So in this particular case, the minimum DCR here is 1.1. That means that my net operating income, right, and it's not your cash flow, it's your income before you service your debt, covers my annual mortgage payments 110 times. So you only have a 10% buffer there. That's pretty thin. So I caution you, if you go that route, I'm of the same view of Seth, especially I'm like Seth, I raise private capital. You got to be careful there. So that's not a lot of buffer. So you need to pay close attention to this kind of stuff.
Yeah, perfect. That's beautiful. Sorry, go ahead, Pierre-Paul.
No, I think, I don't know, Seth. I mean, I mentioned that's kind of it for CMHC MLI Select. So your job, my job in this particular case is to flag these new policies and new products to people. So I think you want to take close consideration, pay attention to this program, because I think it can make some headway. But Seth, I completely agree with you. The time to invest in multifamily was, you're a young guy, but I'm 60. I wish it was 40 years ago that I had begun investing in multifamily properties. In a time of turmoil like we're experiencing, as you said many, many times already today, it's one of the soundest assets that you can invest in, precisely because the risks are well mitigated. Your vacancy risk is mitigated because you got multiple income streams within a building. Lenders, by the way, Seth, is the second asset class after principal residences that lenders love to lend on are apartment buildings. So lenders are always keen to lend you money. But as you said, you got to present a good management plan, what's your exit strategy and all of that jazz, if that's what you want to do. So
yeah,
that's pretty much what I had. Of course, we can talk about other stuff that you raised earlier, underwriting, whatever it is that I don't know, some questions maybe.
We had a bunch of questions come in. So Katie's going to handle this for us, and we can just go through. So David is asking, what are the rules around CMHC and full BRRRRs on value add? And by BRRRRs, just in case you're not sure, it means buy, renovate, rent, repeat. Are they paying out additional equity if it's a full BRRRR, or are there stipulations around this?
Well, the rule that I mentioned about use of equity takeouts would apply in this particular case, Seth, right? So if the purpose of the BRRRR was to pay out investors, shareholders, you could not do that. What they specifically said, they don't want investors like us to use equity takeout funds, because I understand, I don't do BRRRRs that much, right? It's not common so much, at least in my business model, but you can't use the equity takeout funds to do whatever you want or pay back investors. So that's part of the BRRRR model. That wouldn't work under CMHC. Definitely not.
Excellent. Great question. Okay. We have a random Facebook user who doesn't give us the name. But with the CMHC refi, can you now use the equity takeout to pay back investors, or does the same rule about not being able to do that still apply? We just answered that. So
yeah, exactly. You cannot. And that was very specific. I think it's BS. Can we say the word BS on your show?
Sure. Yeah, we can say BS. Yeah.
Okay, because I could have shown you the full policy that CMHC had when they came out with that at the beginning of COVID. And specifically, one of the things they said, the CMHC feels that it's an inappropriate use of public money to pay shareholders back. That's freaking BS. I'll tell you why. Okay, and you may not remember this, Seth. I used to be manage default management, a small department in CMHC's Prairie region called default management and real estate. Default of what? Apartment buildings. First thing I want to tell you from my experience in my days managing defaults of apartment buildings, they rarely default. Okay, to this day. All right, even during COVID and during the coming of the recession that we're in, if you do things well and properly, proper underwriting, adverse factors and all of that, you don't have to worry. But anyways, who pays the premium when you get CMHC insured default, mortgage default to insurance? It's us investors. So what public use are we talking? What public funds use are we talking about? It's our money. It's our money when we go CMHC, right? Our premium, and it's a cash cow. It's a cash cow. They don't default. I mean, I know I was bored out of my mind. That's why I moved to the multifamily underwriting department. There was no defaults to manage, clearly, and I mean this, Seth. This is absolutely the truth.
Well, we can say merde.
Yeah, there you go.
Yeah, there we go. Okay, we have Eric or Arik. If the tenants pay for utilities, will the bank still require you to list those utility expenses as part of your expenses to arrive at the NOI for CMHC mortgage underwriting purposes?
Yeah, so that's important. I know when I teach this stuff, got a spreadsheet where you got to figure out, you got to tell what's included in your rents, right? So as long as you can provide the evidence to that effect, that tenants are paying for utilities, that's not a problem. That's what will be taken into account in the underwriting. As long as you like I always tell my students, I used to be a lawyer, right, Seth? So I'm used to crossing my T's, dotting my I's. Provide that in your financing application, and yeah, it'll be accepted. That's not an issue there, right?
Yeah,
but
yeah,
you need to justify that.
Yeah, and depending on your area, that's actually you can implement a RUBS program. So that's resident utility bill back system. That's a common strategy depending on where you are and the tenant laws and all that kind of stuff. So yeah, 100%. Shelly was asking. So Pierre-Paul, this is our rent control question. How do you get existing low rent tenants to leave in Ontario? Well, Shelly, my answer is you have to be very, very careful. Because the landlord-tenant board is fully on the tenant's side. You cannot force a tenant out just because their rent is lower than the market. So my advice would be to stay on top of your annual rent increases. Some people offer what's called cash for keys. You can get into that. Pierre-Paul, I'm not sure if you want to touch on anything.
I could go on a rant. But of course, you can come and invest with me in Alberta, by the way. I could have rent control. So, and I mean this seriously. If you're an accredited investor, give me a shout. No, it's a problem, Seth. I think, as I said, as part of this accelerated, what did I call it? Housing Accelerator Fund and all these ideas that the federal government is seeking. One of them, or some of the proponents, are coming up with more rent control, which is again BS. You said I can say BS on your show because it destroys the marketplace. It provides disincentives for people to build more housing, which is the real problem. So, but in Alberta, we don't have that. I don't think we'll have anytime soon. I don't think we'll elect an NDP government. I sure hope not. But you can increase your rents by whatever the market can bear once a year, but without the province putting a cap on rent increases. As a matter of fact, I just went through that. My rent increases, first one in 6 years. It's been a rough time in Alberta, but they range somewhere between 16 and one unit, I think in one of my billings, 30%. So whatever the market can bear. But obviously, as you said earlier in the show, Seth, you need to do your homework, which is obviously what also I teach to my students, right? What are the market average in your specific area and how much you can raise your rent. So you got to do your homework. A lot of homework in the multifamily investing business, especially when you use other people's money.
Yeah, well, 100%. Lee is asking, how do the 3 T's change for new construction as opposed to acquisition of existing? Yeah, so Lee, I don't really work on the development side, but yeah, the same principles will apply, right? You're kind of figuring out, what's the opportunity today, your cost of building, the cost of the land, your capital stack structure, how are you going to finance it, all that kind of stuff. Then you figure out, well, what's your plan once you build it, right? Some people build to rent it. So they'll build an apartment building, rent it, hold it for 5 years, and they'll exit. Some people will build then sell right away. So the principles still remain the same. It's just going to be slightly different because you don't have existing rents, you don't have an existing building you're looking to level up. You're kind of starting from scratch for that one. Sam's asking, in new construction, does CMHC finance the construction under some kind of bridge financing and then convert into permanent financing, or is only one loan funding both construction and the hold for 10 years?
Great question. Love that question. And that's obviously stuff when I teach my course, that's something that I put a lot of emphasis on. You're right. Absolutely. So bridge financing, first thing you need to understand, is not CMHC insured. CMHC does not do bridge financing, right? It's usually a standard loan term of 5 years. So what you do, and this is the kind of stuff that I teach you, I get a chart for that, the kind of situation that you're in, and whether you should go CMHC financing or take a conventional loan, which a bridge loan is a conventional loan. Let's just explain what a bridge loan is for people watching. A bridge loan is a temporary short-term loan, usually about 12 months, right? And the reason you get a short-term loan like that, or a bridge loan or mezzanine loan, there's a third term, bridge loan, mezzanine loan. Yeah, anyway, I forget there's a third term, but it is because you're not ready to commit the deal to a full 5-year standard loan term, to use a standard loan term of 5 years. All right. So you need to do a few things. So maybe a value add, very likely, like Seth mentioned earlier. Maybe you need time to increase your rents, to increase your NOI. Seth, who's your best friend when you invest in multifamily properties, by the way? Do you know that?
Who's my best friend? The lender, I would say.
Multifamily properties.
I would say the lender is my best friend because they want to get me all the money.
NOI, net operating income.
Okay, NOI.
Oh, Seth, you got to take my workshop.
I do.
I'm just joking, but I ingrained this in my students' head when I teach this stuff. The reason being that our job is always to maximize our NOI. So you would take a bridge loan in a circumstance where your NOI has not been maximized, or the performance of the asset hasn't been maximized, all right? And you go and fix the property, you get rid of bad tenants if that's what you have to do, and complete whatever upgrades you do. So you need time to do that. So what you need to understand about a bridge loan, though, the interest rate is a lot higher than a standard loan. These days, CMHC, the last I got a few weeks ago, I think for a bridge loan, now in interest rates have gone up since, it's probably about 8-9% for a bridge loan. So just to recap about a bridge loan, it's a short-term loan, usually 12 months. You pay a high interest rate. You need to tell the lender upfront what's your exit strategy, how the bridge loan is going to get paid out by you at the end of the bridge loan. And then you need to tell the lender, ideally upfront, you should think these things through upfront, which way you're going to go. You're going to go conventional financing, or you're going to go CMHC route, okay? And these are things, when you get into a deal, you decide to take a bridge loan, you need to figure out in advance, not last minute kind of stuff, okay?
Okay, great. So we got to end right at 1 o'clock. So we'll power through a couple more questions. So Mary is asking, if your building has a mix of units, so you've got a bachelor studio, 2-bedroom, does it matter which type of unit you make as the affordable one?
I don't believe it does. I'm not. This is a very new product, so I've not used that product. I don't think so necessarily. I think it's the matter of the income being below the medium, at maximum 30% of the medium income, renter income, I think. So I'm not an expert. This is fairly new, Mary. So what I suggest you do, Seth, you'll give my contact to people. Yeah. I'll connect you with somebody, an expert on that, but I don't think it matters. What matters is making the units affordable, if I go by the social outcomes that are being pursued.
Yeah, excellent. Mary's asking, are there stats on the current usage of the MLI Select program? I'm not sure.
Oh, it's probably too fresh, but the the take up for this product is quite significant. I wish, Seth, I were in the development business, because I would take advantage of that program for sure, given the flexibilities.
For sure. Oh, Marco's on here. Hey, Marco. On new construction multifamily development, is it possible to receive a 95% LTV in a 50-year amortization period?
Well, the 95%, definitely, that's what we looked at. And let me just look at the slide. Seth, are you able to put that slide? Yeah, up to, if you get 100 points, so I got it here. If you get 100 points, you're right, Marco. And Marco, you should sign up. He knows what I'm talking about. He's been communicating with me. Up to 50 years if you get 100 points, okay? So if you know, when we go through CMHC's MLI Select, at the bottom line, Seth, if you can share it or not, doesn't matter. You can go up to 50-year amortization. Now, just remember, when you go, so that last one there, right? Just remember, though, guys, the cost of money is going up. If you amortize it over 50 years, it's going to take you a hell of a long time to pay it off. So that's why I said earlier when we talked about that slide, you got to put this in context as well. Does this fit your business model? And a minimum of 1.1 DCR is pretty freaking tight. I wouldn't like that myself.
Yeah, and you have to look at risk versus reward as well, right? Like if you're leveraged up to 95%, it just takes a 5% swing in the market and you are underwater.
You understand? You and I understand that. That's what I'm saying. I completely agree.
Yeah. So you know, even though just because you can do something doesn't mean you should.
Thank you, Seth. You and I know what we're doing here. And the DCR again, safe. To me, the higher the DCR, the better. Just to answer quickly Dennis's question. Yeah,
like most lenders, like you'll need like 1.25 or something like that in terms of your DSCR. We still have a couple more questions. So if you buy a building with private equity partners or private mortgages through B lenders, how long after buying can you refi?
I don't have an answer to that personally, Seth. Maybe you do, but I don't deal with B lenders.
Yeah, like it's going to really matter on the lender itself, right? Like basically what you need is you need the NOI to support the debt you're looking to place on the property. And as long as your DSCR, as long as your business plan falls in, a lender is going to lend on the property. So I would suggest you just talk with the lenders you're looking at, find out exactly what they're looking for you. So, hey, listen, like, you know, if I hit these targets, am I good to go? If they give you the green light, then run with it. Adele's asking, can you refi to pull out your own down payment money out?
Well, like I said, for CMHC, the use of that equity takeout money is restricted to these uses that we talked about, right? Building another one, paying out a construction loan, completing CapEx, capital expenditures, and so on, or paying out a construction loan. Yeah, I said that already. So that's, but technically, so if you don't, if that's, so that's the CMHC side. If you want to do whatever you want to do and recover your down payment, then the best route is to go conventional financing that is non-CMHC insured financing is what I would recommend you do in order to do that.
Okay, great. So Katie, this is the last question here from Lee. Does the point system have to be mixed between different point sources, or can they all be from one source, i.e. all from the GHG section or mixed from GHG and affordability?
They can be mixed. Absolutely can be mixed. Yeah.
Awesome. Well, you know, Pierre-Paul, we just hammered you with questions for like 15 minutes. So
that's all right. Used to it.
That was great. So I want to announce the winner of the t-shirt today. So the winner of the shirt is Adele. Adele Dig, you are winning the t-shirt. So what we need to do is we'll get in touch. So just email Katie. She's put her email on the bottom there. Get in touch with Katie. We need to know your size, your shipping address, and we'll send you a shirt. Unit size matters. These are the best shirts ever. So really excited for that. And also a reminder, we've got the draw for the loaded elite ticket for the multifamily conference. We're giving away a free ticket at the end of the month. Like and comment on the video to automatically be entered in. Katie's on it. She's got the spreadsheet going for everybody who is entered. And we will be announcing that at the start of December. So Pierre-Paul, thank you very much for joining us, covering all the new CMHC programs. I really appreciate it. Always a pleasure to have you.
Likewise, Seth. Thank you for having me on. We'll see you soon.
Thanks, Pierre-Paul. And I will see you on Wednesday at 12 p.m. Eastern Standard Time for Wealth Wednesday. We are talking about joint venture mistakes. I've got some personal lessons I've learned from that. And Elizabeth Kelly will be joining me to cover everything you need to know about joint ventures. So I will see you then. Happy investing.